everyone. Did you choose that walk-in music?
Yep.
Okay, yeah.
That's my theme.
Great to see you.
Nice to see you, Jason.
This is a great crowd that we have here to listen to what you have to say. I love talking to you in these contexts because you are experienced, relentlessly curious, and so well connected. And part of it stems from your network of people, but also I think it's fair to say you're sort of now not the CEO, but you were for a long time the CEO of CEOs. You have this portfolio of companies. And they give you great insights into what's happening in the world. So I want to start there. What does the world feel like right now to you as an investor?
I sort of feel today like I'm on the beach. Sunny, nice out, but I've read there's a tsunami coming or some sort of a major storm. I don't see it, but it's coming. And what we're seeing is it's a tale of two worlds in a way. The goods sector is slowing down. Inflation's starting to affect a lot of companies, not able to pass on the cost as easily as they had in the past. And then you got the services side. And the services side is doing exceptionally well. Travel, leisure, et cetera. And that's doing very well. And I don't see right now any real slowdown. Having said all of that, we do expect inflation to stay stickier overall, and in large part for several reasons. One is tight labor market, very tight labor market. That's not getting a lot better. The one thing that I guess I could be encouraged by is the participation rate from 25 to 50-year-olds has actually picked up, and I think it's over 82, 83% now. That's quite good. The 50 and over, 55 and over has really declined, and it's in the 30s, like 38%. So you're going to have a tighter labor market for longer, in my view. That's tough. Secondly, you have inflation should stay up because of the energy transition. CapEx, enormous amount of money being put into that. I think that will keep inflation up as well. And then, of course, geopolitical tensions. Our companies, and we have at any one time more or less 200 different companies around the world, they're seeing a lot of the same thing. It's business is not terrible. Revenues are up double digit. Earnings are up high single digit right now in general. And, we expect that to continue as long as we manage the cost side.
And so when you talk to these CEOs, are they nervous, excited, cautious? How would you characterize them generally?
Well, I don't know how you get very excited about inflation running where it is, and a slowdown in the economy. But having said that, yes, right now I'd say they're cautious.
Yeah.
And they're cautious on CapEx. They're cautious on expansion. Supply chain has gotten better, but it's still not perfect yet. You still have issues with China, and a lot of our companies have used China as a supply base. And so, yeah, we're just being cautious. And I think that's the right thing to do right now. Also being cautious on over-leveraging any company where we can, try to push out the maturities, et cetera. And
I would imagine that leads to a decidedly not robust deal-making market. Is that fair to say?
Pretty quiet. If you think about it, Jason, today you've got look back at 2021, say July 2021, you had high yield, IPOs, and private credit, or credit, not private credit, at about 8.5% of GDP. Today, April, was about 1.3% of GDP. So what's happened is you have a much tighter, capital market. That just makes it tougher to do deals. Having said that, the private credit market is very strong right now, and people like KKR and others that have a large private credit business, we're able to fill the gap and do things. Secondly, we bought several companies that we just did all equity. And we'll finance later when rates come down, and we've got plenty of equity capital. We'll buy them with just equity. And so what you're going to see, I think, is a sustained period of time where the capital markets will stay tighter. It is not, to date, a credit issue. Could become a credit issue, but it's not there yet. It's more of a liquidity issue right now as to why you're not seeing as many private equity deals done.
I want to get in, based on what you just said, get into a little bit of the guts of KKR, because what you just described is a very different firm from what you and Jerry Kohlberg and your cousin George Roberts started in 1976. 95% of the money that you raised last year was not private equity. It was all in those areas that you described and more. How would you describe this firm right now?
Well, I think you have to go back a little bit and understand the most important conversation that Jerry, George, and I had in 1976, and that was, what kind of culture did we want to have? And it was very important to us to have a culture where everybody was included in everything we did. That meant that everyone was paid for and got part of the carried interest, part of the fee income, because all we did when we started was private equity. Whether you worked on a deal or you didn't, whether you were a partner at the firm or you were not a partner at the firm. Fast forward 47 years, we have 26 offices around the world, maybe 40, 45 different products that we have at KKR today, ranging all the way from every kind of credit product, infrastructure, real estate, private equity, growth equity, et cetera. And today it is exactly the same culture. Everyone at the firm gets to participate in everything we do. So that means that if I came in to see you and you're the CEO of a company, it used to be all we could talk about is your company for sale. Today, let's get to know you. We are very big believers that people do business with people they like and trust. And so build a relationship, and that's really how we go about it. And then eventually you find out, because everyone at KKR has a toolkit, they find out that, wow, this company needs to redo their balance sheet. This one wants to make an acquisition, but they don't have the banks covering them anymore because we're in a tighter credit situation, et cetera. We're able to provide capital up and down the capital structure. So yes, that is correct that last year, about 95% of the money we raised, which was somewhere in the $75–80 billion range, was non-private equity. And the reason for that was we had finished raising large private equity pools of capital already. So that money was used for climate, for ESG, for real estate, for credit, all kinds of credit, and for infrastructure. So today we're a very diversified firm, able to be a solutions provider to many companies anywhere in the world. And that's really was by design what George and I and Joe Bay and Scott Nuttall really worked on over the years.
One of the interesting things that you've gotten into, and Joe Bay, the co-CEO, talked about this a couple weeks ago or in the last week or two, was getting into the high net worth area, a new fund related to that. I mean, this has long been the holy grail, a holy grail for folks in the alternative investment business. Talk about that opportunity, if you will.
Jason, that's a huge opportunity. First of all, in the high net worth area, there's about $178 trillion of capital, net worth, income, et cetera. Today, 1% of that is in the alternative space invested. So think about that. If you just got to 3 to 5%, what does that mean? That's trillions of dollars that will be able to go into the alternative space. When I talk about alternative, what I'm saying is that's private equity, that's infrastructure, that's real estate, it's maybe private credit, et cetera. And so we have come up with democratized products across the board here. We're working with different registered advisors and getting on different platforms to sell these different products. This is fairly new for us, but initial reaction so far has been very strong. Because if we'd had this conversation 10 years ago and you said to me, do you think that KKR will ever be dealing with the high net worth population? I'd say, yeah, in a small way. But today, we're now able to deal with the high net worth population globally in a very major way. And that's going to change the complexion. These are pools of capital that will, be fairly well tied up for 5 years at least, if not longer. And we're going to, I hope, take advantage of the opportunities there today.
So one of the things that's going on at the firm, you're now a year and change, I believe, into a pretty major transition, which is your job has changed. You and George handed off the CEO roles to Scott Nuttall and Joe Bay. So what's your job like now?
Well, first of all, I'm glad after 45 years to finally get promoted. So I'm really happy about that. So George Roberts and I, we both founded the firm with Jerry Kohlberg, and for 45 years, George and I were co-CEOs, and we're now co-executive chairman. We meet officially once a week with Joe and Scott. We help them think through strategy. They're running the business. This is, given to them. And by the way, this took a lot of thought on George's and my part. We didn't wake up one night and say, okay, let's just pick some people out of the air. We actually started with about 7 people that we thought possibly could do the job, narrowed it down to 3 people. That was over a 7-year period. And what we did then was to make Joe Bay and Scott Nuttall co-chief operating officers in, I believe, about 2017. George and I stayed as co-CEOs, and we kept giving more and more responsibility to them. Let's see how they do. And they did a phenomenal job, particularly during COVID there. The firm grew dramatically during that period of time, and they performed magnificently. They showed real leadership. Now, picking 2 people, I've heard over and over again, 2 people never work. Yes, we've got lots of examples where 2 people don't work. At KKR, George and I grew up together. We're 4 months apart in age. We met when we were 2. We're first cousins and best friends, and that's the best partnership you could have. So what we saw in Joe and Scott was the fact that they came into the firm together, probably 26 years ago now, grew through the firm together, and their families are best friends. But there was one piece that we focused on very much. Obviously, they've got capability of leadership. Did they believe in and live by our culture? And that was critical, because if we lose the culture at KKR, this culture of inclusion, everybody participating, we lose our DNA, and they live by it. And so that was a very important part. George and I have always believed that if you, because we're often asked, how did you make it work so well? And by the way, you 2 must fight a lot. Oh yeah, we had, I think we had a terrible fight. We both were 7. And he wanted to ride my new bicycle. He had just come up to Tulsa from Houston for Christmas. I got in his new bike, and I got chased in the house because I wanted to ride the bike first. I wasn't a very good host, and I ran in the corner of a wall and cracked my head open, and I had 26 stitches. That's the last fight we've had. There's no reason to fight. Go bust your head open. So we...
And who says Wall Street isn't a contact sport? Come on.
That's right. So in Joe and Scott, we saw many of the same characteristics and same friendship and camaraderie with their families and the 2 of them that George and I have. And so it became pretty natural for them to then succeed us. But, we built this over a long period of time, because we always said we wanted a firm that survived long after George and Henry were gone, and it contained the same DNA that we've been able to build for many years in the past.
One of the things I always like to ask you about is New York City, because you've been a steward of this place since you came to Columbia Business School back in the day. You've been very involved from a civic, philanthropic, and obviously business perspective. What do you see in New York City right now? You've moved to Hudson Yards. The firm is now located there. What does New York City feel like at this moment? Wildfires notwithstanding.
No, I worry about New York, and I think it's going to take a long time, because we have something today that we didn't have before, and that's the aftermath of COVID, of just getting people back to work. Now, I'm happy to say that at KKR, we got people back about 2 years ago. And what we said was, we're an apprentice model. People learn from each other, so we expect you to come back in, and they did. Now, it didn't hurt in New York, for example, the fact that we had a brand new office, we had great food, and people wanted to be together, and you learn from each other. One of our biggest challenges in New York, and the challenge for Mayor Adams, is going to be to get people back into the office, and that's going to be tough. It still isn't happening yet. It's better than it was. So that's one worry. The second worry that I have is just crime. I wish that the mayor and others in the government could figure out a way to be much more focused on penalties for people that commit crimes. You can go into stores and take up to $1,000 and not much happens to you, if anything. That's wrong. And so we've got to, I think, start getting tougher on crime. And it's like the broken windows theory. One window gets broken, another one's broken, pretty soon the whole neighborhood's gone. Well, that's what's happened here in part. So I think this whole turnaround of New York, it can happen. I love New York. I've lived here since 1967, and coming from Oklahoma, but I think it's just going to take a long time to get back to where we should be.
All right, well, as we start to wind down a little bit, I have to ask you about a very important topic, golf. You're a very good golfer. I know that from a number of people, including my boss and your friend.
Don't believe everything you hear.
You're a deal maker. We saw a hell of a deal yesterday putting the PGA and LIV together, at least on a commercial basis. As a deal maker and a golfer, what do you make of it?
Look, I don't know all the details, and my bet is there's a lot more than what the headlines say, that the fine print is really important. But I think getting together is the best thing for golf. This fight that was going on and the lawsuits that were raging in, one side, the golfers from LIV, and taking shots at the PGA and vice versa, that's not constructive for the game. Golf for a while was very flat years ago. Tiger Woods got into the game, and all of a sudden, the number of participants in golf increased by 2-3 million participants. And then it started back down. So the worst thing, yes, it sort of makes interesting reading, but it is not constructive. So I would say this is constructive. As I say, I don't know all the fine print, the details, but I'm very happy that they've gotten this behind them. You've got some very capable people on the PGA side that are on the board there, headed by Ed Hurley, and Jimmy Dunn's on that board. They know a lot about golf, and they're deal makers. They know how to get things done. So when I saw the headlines come across, I couldn't be happier that this is, I hope, now behind us, and we're going to be able to go forward with the game of golf. Because the game of golf is not just what you see on the TV or just the pros. It's all of us that go out on weekends and get a chance to knock the ball around. And
as you reflect on where you are, I mean, we've talked a little bit about succession. We've talked a little bit about what you're doing. What energizes you at this point from a business perspective or even personally? I mean, this is a pretty remarkable chapter that you've entered into.
Well, I happen to love where I am right now. First of all, I'm asked from time to time, so what drives me? Well, for years, what's driven me, and today it's exactly the same, if not even more so, is curiosity. I don't think that anyone can be a great investor unless you're curious. But you got to be curious about a lot of things. It's not just the stock or the stock market. If I took people to the window in our office, and we go from 74 to 80, and said, look out, what do you see out there? I hope that they would say, I see possibility, as opposed to, I see the tugboat in the Hudson River. You've got to see opportunity and see where, connect the dots. And so what drives me so much today really is curiosity. I'm spending a lot of time, which I've done since 1998, but I did it out of my back pocket, in the venture startup world. We didn't do it at KKR, so I was able to do that. Today, I built that up significantly and having a lot of fun meeting with young companies, entrepreneurs, et cetera. That's fun. Secondly, I'm very involved in an organization called Sponsors for Educational Opportunity, SEO, and that's critical for me. It's helping the underserved community get a good education from 9th grade through college, so it's an 8-year program. So I spend a lot of time on that. And I'm still very involved at KKR. In fact, I'm as busy today or busier than I've been, except I don't have to worry about all of the detail day to day.
Sounds like a pretty good job.
It's a great job.
All right. Thank you for spending time with us. Please help me thank Henry Kravis.
Thank you.